What's up, everybody? Hayden here again. In my last video, I talked about your debt to income ratio and why it's so important. It's so important, in fact, that I mentioned the word important 9 times in one video. So take that as a data point, I suppose. If you want to check out that video, please refer back to it on the channel and give it a check out to see if it adds some value to your life. Hopefully it will. This video is the nuts and bolts of how your debt to income ratio is calculated. So let's dive right into it. On the top in your debt to income ratio, you have your debts, and on the bottom, you have your income. It's a simple fraction. Now it's time to fill it in. The debts portion on top includes basically anything you're paying monthly that is going to affect your ability to pay the new debt. That's what we're really looking at. That can include your current mortgage. That can include the rent that you're paying where you live. That can include student loans, it can include personal loans, it can include credit card payments, or any other types of monthly payments that you need to make. It all goes into that numerator on the top. Sum up your debts. There's 2 things to keep in mind for this, especially we're going to look at this through the lens of buying a home. Now, when a lender is looking at your account and they see that you're currently paying X dollars per month for your rent, but they know you're going to be moving into a new place, they'll wind up backing that number out because they know that those dollars can be applied toward the debt service of wherever you're going to go. Additionally, for credit cards or other types of debt that have a minimum payment, but you may have a higher balance, only the minimum payment is what gets included in there. So if you have a $3,000 credit card balance, instead of putting $3,000 in that, you just wind up putting the minimum monthly payment that's required to keep your account in good standing. And that's really it. That's all you need for the top half. So go ahead and gather those numbers. You may have them committed to memory because you're paying them every month, and sum that total up in the top. That'll give you the top half of the fraction. All right, now we come to the bottom half, the income section. And the income section is a little bit more complicated. And in short, it's because you got to prove that income. And how they look at it and what they will and won't count is something that often trips up a good number of people. So let's dive into that a little bit more. There's a lot of potential sources of income. You've got your salary and wages, commission sales, bonuses, alimony, Social Security, retirement, any other really monthly income that is consistently coming in can oftentimes be allocated to that income number in the bottom. So that's important to remember. There's a good number of sources and some of them are treated differently. We'll dive into that a little bit later on in this video. So how's this number actually calculated? They look at your taxes because they need something reliable that has been through checks and balances, hopefully been audited, and that's a reliable source of financial information about a person. So they're going to ask generally for your last 2 years of taxes, your filed taxes. And that can get a little bit clunky if it's toward the middle of the year, you haven't filed your most recent year, and can sometimes be a deciding factor. If 3 years ago things weren't looking as great, last year things turned around, and this current year or the year that you just finished was looking really good, sometimes you're going to need to strategize based on when you have your filed taxes available to share with an underwriter. Let's dive into a few examples, shall we? Let's build a hypothetical scenario with some rough numbers so you can get a better idea of what your debt to income ratio number at the end of the rainbow actually looks like. Let's say somebody's currently paying about $1,650 per month for rent or a mortgage or whatever their cost of housing is every month. And let's say on top of that, they've got an auto loan for $239. Maybe they put a decent amount of money down or bought a more affordable car so they don't have a $700 or $800 a month payment, but their payment is still every month $239. Now let's say, like many young people, they are saddled with tens of thousands of dollars of debt for student loans. It's an unfortunate epidemic that affects a lot of people in their 20s and 30s at this point, some even in their 40s. So let's say they've got tens of thousands of dollars of student loans, and the payment for that, to keep it current, the minimum payment, $487 a month. That brings their total debt to $2,376 per month. Now let's go down to the income section, and let's say this person, as you can see from the column heading, is a W-2 employee, and they're currently making $77,000 per year. You would take that $77,000 number, divide it by 12, and get yourself $6,416 per month. And right there, if that's all they have for income because they're working a full-time job, keeping crazy hours, and also taking time to have a life too, let's say that's their total income and these other buckets don't apply to this person. That would bring their numerator to 2,376, their denominator to 6,416, and their total debt to income ratio on this after you calculate it out, 0.37%. We'll go into what debt to income ratios people are looking for a little later on, probably in another video, but it's good to be able to calculate this number on your own. Next, let's take a look at what a 1099 situation might look like. Now let's start with somebody who's still building their financial life, and maybe they're doing the smart house hacky thing, and they've got 2 roommates sharing a 3-bedroom place, and their share of that is only $800 a month. Maybe on top of that, their vehicle is paid off because they bought it in cash for a few $1,000s, or they've already paid it off, or maybe it was a gift from their parents or their grandma or somebody's old car. But let's say for this sake, they don't have a car payment. But let's say they do happen to have some credit card debt. Maybe they've got a few $1,000s in credit card debt, and the minimum monthly payment on that is $85. So we're going to put that in. And then maybe say for their education, or they took a training course or something along those lines, they do have student loans. And let's say that number is $223 a month. That would give them a monthly total debt payment or debt service amount at the top of the fraction of $1,108. Now let's jump down and say that this person is working a consulting job a few hours a month, or they're supplementing their income with Instacart or Uber, or maybe they're picking up a few side projects along the way. But all of that money is coming in on 1099. Let's say it's $3,500 a month, so enough to cover all their living expenses and still have a little bit left for meals out and to see friends. So let's say that number is $3,500, and that's all we've got for income. That would give you a numerator of $1,108, a denominator of $3,500, and that would generate a debt to income ratio of 0.32%, which is pretty good. I mean, that's right in the ballpark of what lenders would be looking for a loan like this. Unfortunately, though, there's a problem with this. Here's the challenging part with 1099 income. It's that you have to prove it. And remember when I said earlier that they generally do a 2-year look back on your taxes? That's where this can come to bite a bunch of people in the butt. This backward look is understandable because we can't prove, as much as we want to say we're going to continue making a certain amount of money per month. The lenders and the underwriters have to look at existing numbers, and so they're going to pull up your last 2 years' taxes. And what they're going to do is they're going to take the total amount of money you made from those gig economy jobs over the last 2 years and then divide that by 24 months, and that's going to be your new number that goes into the salary and wages portion of the sheet. So let's see what that looks like. Let's say this person was making $3,500 a month steady state, but they'd only been doing it for the last 10 months. What that would mean is that the bank would take your $3,500 a month, multiply that by the 10 months you've been doing it, provided it's been on at least 1 year's tax returns and you didn't deduct a bunch of business expenses against it. But let's say, just for an example, $3,500 a month times 10 months is $35,000. Even though you weren't working that job for the last 2 years, they're going to divide it by 24. And your new number that goes in right here is going to go down a little bit. Once we crunch that new number, we see that the $3,500 number that was right there, unfortunately, it goes down because they're taking your $35,000 and dividing it by 24 months. And that gives us a new number of $1,458, which, just like that, takes this number from being 0.32, goes up a little bit, goes up to 0.76. And just like that, you're upside down on your debt to income ratio, and most lenders aren't going to lend to somebody whose debt service payments are such a high percentage of their qualified income. So that's that. And it's unfortunate. It's something I've run into. I know a lot of people have, especially as more and more people are working 1099 jobs. That 2-year look back and the requirement that that income appear on 2 years' tax returns is pretty difficult. So anyway, I know there's a lot more to this. This is just a structural example of what the process looks like. There may be some nuance here. It may be one of those things where even if you've only been working for 10 months at $3,500 a month, if you haven't had that reflected on even 1 year's taxes, it might get excluded until you have it on at least 1 year's taxes. Or it might be one of those things where they don't even count it at all because you don't have it on 2 years' tax returns. Even if you've been working at it for 23 months and you haven't filed your taxes yet, or it hasn't been 2 full years, or it hasn't shown up on 2 tax cycles, that income, even if it's steady, if you're making it every month, if you're reliable and you're doing it all the time and getting your hours in and bringing home the money, there's a world where that money won't be able to work to your benefit when calculating the debt to income ratio, which is part of the reason why this is so frustrating. And even though you know the money's coming in and you're planning on it continuing that way, and you know you'll figure it out if something changes, you might not get the approval that you're looking for on the loan. if you don't have it. So to end this on a somewhat down note, that's the reality of your debt to income ratio. And I hope you take this to heart because it's frustrating. And it's one of the things that you need to manage and deal with because there's not a ton of flexibility in how these numbers are calculated. My name's Hayden. This one was a beast. This shirt is way too blue for this background. And I'm looking forward to the next video where we build on the progress and the momentum that we're already making. Shout out to the handful of people that have watched these videos so far. If you are enjoying them, please leave a comment, like, subscribe. If I got something wrong, please correct me. I want to do this better and better. And that's all for now. Keep working hard, my friends, and take care.